All right. So, now keep in mind, Simone, now the funds are being paid to the charity, okay, up front, hence its name, lead. Everyone got that? It's a lead trust. And the annuity amount or the unit trust amount is being paid to the charity. At the back end, it's vested with a non-charitable beneficiary.
Now, why would that happen? Oh, meaning like instead of a lump sum,
So instead, I put $1 million in trust for the Red Cross for 20 years, or for Young Hung's life. Often it's a term of years. And after 20 years, the funds vest with Young Hung. Okay? And presumably, Young Hung is wealthy, and she didn't need the money. And that's why we're able to suspend it for 20 years, and then 20 years from now, she gets the money. Now, my experience is, again, I don't have that much experience with charitable lead trust, just periodically this comes up, is that very, very, very wealthy people whose children are very, very wealthy will set up these trusts where the money ultimately inures to grandchildren. And they hope that after X number of years, if the trust does very well financially, that there will be a big remainder interest at the end of the trust. Because if the trust pays X dollars to a charity, right? And let's just say it has to, in my example, 10% or $100,000 to a charity, but the trust actually gets a 25% return. Well, after X number of years, there's going to be a lot of money left, right? That will go to the non-charitable beneficiary.
how does that, so the remainder, you don't know what your deduction will be.
You know what your deduction is up front.
With the lead, you do.
You do it with the remainder, too.
Well, how's that? Because
You compute the actuarial interest that it's going to flow to the charity. Here, you can compute, again, what's the actuarial interest going to the charity, and what's the remainder interest. Here, the lead interest is what's deductible. Now, that's predicated on one thing, though. How do you get a charitable deduction for a lead trust? What does the trust have to be? Do you recall from... What does the trust have to be in order to secure a deduction? Close. It has to be a grantor trust. Okay? You cannot get a charitable deduction unless the trust is a grantor trust.
Can that change? Like, is it set from the get-go, or can that change year over year? Can that grantor trust status change year over year, or no?
No, it's going to be a grantor trust by its terms or not.
Oh, yeah.
So it's not going to change annually. Okay, so charitable lead trust, you can only secure an income tax deduction if it's a grantor trust. So this is spelled out on page 13, Karen. I don't know what page it is on yours.
Yeah, it's just my print is smaller, that's all.
All right. The second full paragraph on page 13, it says, in general, a donor is not entitled to an income tax charitable deduction if transfer is made to a charitable lead trust. An income tax charitable deduction is only available if the CLT is structured as a grantor trust. So it's got to retain one of the powers, enumerated powers, that causes the income of the trust to be taxed to the donor.
And what page was it?
Page 13. But here's the issue, and this is again why people might hesitate. Suppose I set up this trust for Young Hung's benefit, right? I'm going to switch it now. Charitable aid trust, so it's for the Red Cross and then to Young Hung. And I want a charitable deduction, right? So you say, okay, you can have your charitable deduction. You got to set it up as a grantor trust, right? Everyone agree? You're going to set it up because that's this. It's required for me to get a charitable deduction. It's got to be set up as a grantor trust, right? However, it's a term of, let's just say I make it for a term of 10 years to the Red Cross or 15 years, whatever. But just go with me that it's a term of 10 years, okay? During that 10-year period, who gets taxed on the income? Me. So this was a big price to be paid that, yes, I get a charitable deduction up front, but for the next 10 years, whatever income that trust generates, I have to pay the tax burden. So,
Does that offset?
I mean, it may or may not. It depends on, was I in a high tax bracket when I made the contribution, in a lower tax bracket when I had to pick up the income, or vice versa. I can come up with 1,000 variables, all right? All I'm pointing out is, we know in this class, right, that having grantor trust status has its consequences, right? We saw, on the board. So, just pointing out, there's a somewhat steep price to get a charitable deduction with a charitable lead trust. Now, Simone, that's not true with the remainder trusts. These remainder trusts, there's nothing said about being grantor trust status, right? Everyone agree? And we talked about how people are taxed, right, under the 4 tiers. But when it comes to charitable lead trust, if it's a grantor trust, the grantor will remain taxable. If it's a non-grantor trust, keep in mind the charity gets the money. It's a charitable organization. It's not going to pay tax. I should point out, and on the bottom of page 13, I misspoke a bit. The last paragraph. A non-grantor trust is one that its donor has not retained any of the powers. If the CLT is treated as a non-grantor trust, the CLT is taxed under the normal rules that apply to complex trust, meaning the CLT is taxed on its undistributed income and capital gains. So, beginning on page 14, there's a discussion of grantor charitable trust. Check grantor charitable lead trust. There's a discussion of, there's a recapture provision that the grantor, if the trust terminates for any reason, there's a recapture provision, which I won't get into. It's spelled out on page 15. And there's an actual example that we have that follows on page 15, that the grantor dies during the lead term of the trust or otherwise ceases to be treated as the owner of the trust for income tax purposes, or part of the income tax charitable deduction will be recaptured as ordinary income. So the point is, yes, you can get a charitable deduction if it's a grantor trust, but the price tag is significant. The price tag is, for whatever the term is, you're going to pay tax on whatever the trust generates, and if the trust terminates for any reason prematurely, you're gonna have to recapture that charitable deduction. You're not gonna, and that, the example that follows on page 15 spells that out, illustrates the recapture provision. How do we make this into a grantor trust? On page 16, some of the things that you might consider in terms of making it into a grantor trust. Okay, these are three ways, common ways that people set up grantor lead trusts. And then there's the discussion on page 16 about non-grantor lead trusts. It talks about how those trusts are subject to tax. So what I'd like to do, because there's lots of questions here at the end, I really want to hone in on these questions and make sure we get through the vast majority of them. Because when we start, I think our next class is November 28th. I really just want to focus on the IRD, so I want to make sure we finish this up today. On page 21, we have a non-grantor charitable lead annuity trust. Okay? Non-grantor charitable lead annuity trust. Requires an annual payment of $30,000 to the charitable lead beneficiary. The trustee, not having cash to make the payment, transfers appreciated stock having a fair market value of $30,000 with a cost basis of $10 from the trust to the charity to satisfy its payment obligation. What, if any, are the income tax consequences to the trust? In that case, does the trust have to recognize a $20,000 gain, guys?
I would say no.
You would say no. Why?
Because it's a payment going to charity.
But is the trustee obligated to satisfy this dollar amount?
Yeah, you mean Kenan?
I mean Keenan. So Keenan would give rise to a $20,000 capital gain here. And keeping in mind this is a non-grantor charitable trust, and as I corrected myself, a non-grantor charitable trust has to go through the same exercise of filing a 1041. Question 2. A grantor charitable lead trust, annuity trust, allows the donor to obtain an individual income tax charitable deduction, but also requires the donor to report the income earned by the trust on his individual income tax return for the year the trust is classified as a grantor trust. Can you think of reasons why a donor would want to establish a grantor charitable lead annuity trust? And like I said before, and I alluded to this with Karen, you would consider setting up a charitable lead annuity trust if you thought, gee, I'm in the highest tax bracket now, and yes, for the next 10 years they would have to recognize income, but that the trust generates. But I'm retiring, and I'm going to generate very little income, so that's okay. And another reason people set up charitable lead trusts, the real reason, let me tell you, my understanding, I had nothing to do with it, is folks like the Kennedys, okay, very, very wealthy families, might put in, make up a number, say $100 million to a charitable lead trust. And they do it in a way that the current interest for actuarial purposes is $100 million. And that the remainder interest is literally zero, okay? The hope of the Kennedys and Kennedy-like families is that if the trust really does perform well, that for gift and estate tax purposes, they've used up no portion of their lifetime exemption, right? Because actuarially, the remainder interest is zero, right? That's going to the remainder beneficiary. Everyone have this? In other words, you set up for a term of years, and the annuity amount going to the charity that is so robust that the remainder interest actuarially is valued at zero. But suppose the trust actually outperforms the assumptions. Well, guess what? There may be 10, 20, $30 million at the end of the trust term that will go tax-free, transfer tax-free to the beneficiaries. Now, maybe the trust won't do well, and there's no downside. When I say there's no downside, assuming you're the Kennedys and you were charitably inclined, well, then the Red Cross did get the $100 million, and your beneficiaries got zero. But they're hoping for the upside. All right. Go ahead, John.
Why does it have to be for like such a large amount?
I'm sorry?
Why does it have to be for such a large amount?
Because people are, when I say this, it doesn't. It can be for $10. But by the time you're done paying to set this all up, and my thoughts are, you gotta be like the Kennedys, where if it doesn't work out, and you're worth $1 billion, and your kids don't get $100 million, they'll sell 900 million. You know what I mean? So they're not gonna lose sleep on it. Where, you know, the average person, or even not the so average person, but your family net worth is 10 million. I don't know, we can get into a philosophical discussion. If you're worth 10 million and your kids only get 9 million, the world will not come to an end, but many people I know that net wealth category do think the world will come to an end. Right? The psyche of someone worth $1 billion is quite different.
What was the answer to number one?
And number one, we just said a $20,000 gain. All right, so let me go through some of these new other policies because I do think it will be useful to hopefully augment our understanding of how these things work. All right, so briefly describe the trust listed below and explain why a person might establish such a trust. So we have a listing here of each one of the different trusts, okay? And I won't use the acronym because I want to keep V in the room. So we'll just call it a charitable remainder annuity trust, okay? What is a charitable remainder annuity trust? And who might use such a trust? And we said, it's got to be a written irrevocable trust where one or more persons are living when it is established, and they're going to receive a sum certain, no less than 5%, and no more than 50% of the initial value. It's got to be for a term of years, not to exceed 20, or over someone's life. And the actuarial value must be at least 10% of the initial value.
Excuse me, is that whichever comes first, like the person's lifetime or the 20 years?
We're going to go through some examples of that. Okay? It could be the longer of 20 years or a person's lifetime. Okay? Why might a person establish charitable remainder annuity trust? They have certain charitable goals they want to try to satisfy. Why simultaneously they want to make sure they have this stream of income. And sometimes people have appreciated securities, which we spoke about that, you know, let's just suppose you have Amazon that you bought for $1 and it's now worth, you know, 1,000, and your charitable remainder annuity trust sells it. That $999 gain, right? ultimately will be taxed, right? Everybody agree? But it may take several years because the annuity payout, right, to the beneficiary may be $10 a year, or $20, or $100. Add a few more zeros to make it interesting. My point is, a charitable remainder annuity trust does defer the payment of tax if there's large taxable gains, because the trust doesn't pay any tax, and the beneficiary only pays tax upon receipt, right, from the tiers. So you can have a very, very significant capital gain embedded in the remainder trust, but that's not going to be subject to tax for many, possibly many, many years, right? What's a charitable remainder uni trust? Well, same thing, but it's a fixed percentage, right? And that number every year is going to vary based on the fair market value of the trust assets. What's a charitable lead annuity trust? Well, here it's an irrevocable trust to be paid to charity for a term of years, or for a term based on the life or lives or one or more person, and provides the remainder interest is to be paid or held to a non-charitable beneficiary. The remainder interest this time. I point out that in my answer, the persons who establish the charitable lead annuity trust can only get a charitable deduction if it is a grantor trust. Charitable lead uni trust, same principles, again, fixed percentage. When designing any of the four foregoing trusts, are there pro forma forms?
Yeah.
Yes, we know. There are pro forma forms and lots of them. Why were limitations placed in 1969 regarding charitable trust? You gotta make sure the charitable beneficiary will receive something of material value. A charitable remainder annuity trust or uni trust have more than one non-charitable beneficiary. You have more than one non-charitable beneficiary. The answer is yes. Code section 664D1A and 664D2A refer to persons, plural. 664D1A and 664D2A refer to persons, plural. May a charitable remainder annuity trust or uni trust have more than one charitable beneficiary? Is that a yes?
Yes.
Yes, they can. More than one charitable remainderman can pass, and this is spelled out in the regulations. 664-2A6, 3 little I, I'll repeat. 664-2A6, 3 little I, or 664-3A6, 3 little I. how often must the payments be made from a charitable remainder, annuity trust, or unit trust? How often?
Annually.
Must be at least annually, right? And Carla, the question was, how long is the maximum charitable remainder trust? And it's the longer of 20 years or life is the maximum. 20 years or life. What kind of investment limitations do the remainder trust have?
Well, it's good not to invest in difficult to value investments for fun.
Just so you know, the regulations say you can't, the trustee can't be prevented from making investments that will somehow prohibit a reasonable return. I'll repeat, the regulations prohibit and say that the trustees, they cannot be prohibited from making a reasonable trust investments. Again, we want some of the money to inure to charity, so they have to be, they can't be hamstrung in what they can invest in. This is in regulation 664-2B and 664-3B. And our annual payments determined under charitable remainder annuity trust. We already said, it's got to be a fixed dollar amount or a fixed percentage of the initial value. Can't be less than 5% or more than 50% of the initial net fair market value of the contributed property. So if you contribute property worth $1.5 million, but it's subject to a liability of $500,000, it's the net value of $1 million. Okay, so now we're going to test you out here. We have a taxpayer creates charitable remainder annuity trust in 2020, they're transferring $100,000 to the trust and reserving a fixed payment of $5,000 per year for life. 3 years later, A desires to add $50,000 to this amount and reserve $7,500. A does do so. Can you do that, guys?
You can do it. You can do it.
You can or cannot?
I know one of them can.
Can you do it? No. No. Two-letter word. No. And it's got to be stated in the trust instrument. No additional contributions. Regulation 664-2B. A creates a CRAD, transfers $100,000, reserves payment for life for 20 years, whichever is longer, of $5,000 per year. Okay? A is 55 years of age. Will A receive a charitable deduction for the remainder? Carlo, this has your name on it. Can you do that?
Don't ask me, I'm no good.
Carlo? What do you think? Can you do it for life for 20 years, whichever is longer?
Yes.
Yeah. Regulation 664-2B, excuse me, 664-2A5, one little I. I'll repeat. 664-2A5, one little I. Suppose the term was for A's life, and then to B, say a child of A, for 15 years, then to the Red Cross. You think that will work, Carlo?
you have 15?
No.
No, this won't work, right? This will not qualify, because now, again, it's for A's life, then to B for 15 years, then to the Red Cross, because this won't qualify because it may last longer than either the lives of the recipients in being at the creation of the term of the trust, or for a term of years not to exceed 20 years. So this does not work under that same regulatory site.
Our version says 20 years.
Yeah.
Hold on, I'm looking at F2.
Yeah, 20 years.
Suppose the term was for A's life and then to B.
Yeah,
No, for 20 years.
for 20 years all his life. That's what the,
And then to the Red Cross?
yeah.
I don't know why there's two different versions floating around. All right, we're working on it. But it really doesn't matter. In either event, it shouldn't work. Question 3, same as 2, except the term was for A's life and then to B for his life, or 20 years, whichever is shorter. Does this work?
Is this one different as well?
Whichever's
I
short.
mean, guys, this should work because it can't ever exceed 20 years. You have
Do we
three
have
different things.
Do we have different questions?
Yeah, it's a different question, right?
What does your question 3 say? F3.
Same as 2, except the annuity is to be for his life of 20 years from the date of creation, whichever is shorter.
All right, we're slightly variation. You know, I added a question actually. I have it. The term was for the. Hold on. Do you have a fourth question? The term was for the longer of B's life, or for 20 years from the date of creation.
Yes.
Yeah.
Yes.
It's 4.
All right, let's just go with that. I mean, you're getting a gist. Does that work?
So where are we right now?
I'm in. The term is for the longer of B's life, or 20 years from the date of creation. You know what, let me do this. There's a little bit too much confusion because it's built in number 3. The bottom line is, generally can't be longer than 20 years or a life in being, guys. You can't design the trust to have like successive lives. It can't be, I'm gonna set up for Alicia, then to Edward, right? And then to the charity. You can't have successive lives. It can be for the longer of 20 years for someone's life, period. And if you have some sort of arrangement which will extend beyond that, it's going to be problematic. Hopefully your question G1 says, what is the 5% probability test discussed in this revenue rule? Right? That's what your next question says,
Yes.
Yep.
That there must be a 5% probability that the charity will receive something. And again, as I said to you before, this is an issue where the payment out exceeds this code section 75/20 rate. So anytime you have a payment that exceeds the current 75/20 rate, this can be a problem. And this only applies to charitable remainder annuity trusts. It does not. The next question says, does this apply to charitable remainder uni trust? And the answer is no, because keep in mind, a charitable remainder uni trust, really you never risk it going down to 0, right? Because the percentage, if you make poor investment choices, it will keep paying smaller amounts, and it sort of has a self-preservation mode, unless the whole trust, gets, decimated. Unless you, who's the guy who had there's lots of them, Bernie Madoff, right?
Yeah.
Then the trust can have 0, but even if it's a uni trust. How are payments from a charitable remainder uni trust determined? Is there a minimum payment amount? Is there a minimum payment amount? There's no minimum payment amount, but again, it's got to pay out at least 5%, but not more than 50%. it would be done quickly, I agree. Well, let's put it this way. With the uni trust, it would just get small quickly, right?
But then it would be like, you would divide the
Yeah,
cents.
it gets. And may a charitable remainder uni trust be limited to income only? We said yes, right? It could be limited. But keep in mind, on the face of it, most people wouldn't want that. Why? Why would you not want to pay out? Because when you're computing the charitable deduction, it doesn't take that into account. So what I mean by that is, going back to my initial example with Young Hung, I'm going to contribute $1 million to a charitable remainder uni trust, right? And every year it's going to pay out a fixed percentage, and let's just say that percentage is 10% to use my dollar amount. And we based upon that, I'm going to get a charitable deduction. Everybody agree? It's not a lead trust, so it doesn't have to be a grantor trust, right? So a remainder trust, I'm going to get a charitable deduction based on the remainder interest. But suppose it only pays Young Hung the income, and it generates very little income, right? That means, truth be told, that a lot more is going to inure to the charity, right? That if this is for Young Hung's lifetime, let's not use the term of years, and it pays out the lesser of the income or the fixed percentage, and for computation purposes, it doesn't take into account the income. It only pays out the fixed percentage. And let's suppose the trust generates very little income. What that means is that the charity, presumably, who's the benefactor of that if it's paying out very little to Young Hung? Who's the benefactor? The charity, right? Because presumably the trust is growing. But am I going to get a larger charitable deduction? No. Because once it's determined up front, day one with the trust, that's it. But later on, if she doesn't get the money, she doesn't get the money. So it doesn't sound like wise planning to have a charitable remainder uni trust that only pays out the lesser of income for the fixed percentage. And you might say, well, it creates administrative ease, because if you have to pay out, if it's a piece of real estate, right, and every year you have to pay out a fixed percentage, that could be a pain in the neck because the trust doesn't have liquidity. So every year you might have to give a percentage, right, of the property, and have a really messy title to the property because each year she's going to get a percent. So paying out the lesser of the income could be administrative ease, make it administrative easier. However, my experience, and I'm going to say this again, not with any I'll call facts, true facts, just my gut, is that 99% of charitable remainder trusts, uni trusts, are set up if they're income only to have this makeup provision, okay? So that at some point in time, if the income generated is more robust, then the makeup provision will be kicked in and Young Hung would be made whole. So look at this, question D. A establishes a crime by establishing $100,000 to the trust, determines in the trust for life paying the lesser of 5% for income, and has a full makeup provision. The trust reports the following. Okay? So try to figure out, guys, take a minute, I'll try to keep quiet. How much does the distributions to A each year? So you got 4 years to deal with it. Some of these things I can fill in because we already know them. Okay, this person is entitled right to the lesser of the income or 5% of the value of the corpus, right? The lesser. But it has a makeup provision, right? So 5% is easy, right? We can compute that. But that's not what it's going to be. They're going to be paid the lesser of 5% or the income, right? So year one, how much are they going to be paid out? Say again, Smoke? How much? The lesser of 5% of their income. Everyone agree? What's the shortfall? 1,000, right? Year two, what are they going to be paid?
6,000.
How much?
6,000.
How much?
6,000.
6,000, right? So I was supposed to be green, but I reached for the wrong. We paid 6,000. Okay. How much was the shortfall from prior years? 1,000, right? And the payment was 6,000. And the shortfall here was $500, right? In the next year, what are they going to be paid?
7,500.
Say again?
7,500.
Well, will they be paid $7,500 or does the makeup provision kick in now? Won't they be paid? Now they have, right? The makeup provision allows them to be paid the extra income now, right? This is when the makeup provision kicks in because now the income is in excess of the annuity amount. The income is in excess of the annuity amount. So here, the shortfall from prior years was 1,500, right? That's 1,000 plus the 500. And the payment here would be 8,500. payment here would be $8,500. And how much is the shortfall?
Left over 500.
We're gonna reduce the shortfall now by a minus 1,000, right? So do you see this proved beneficial in a year in which this person could have retired this year? Because now they're gonna get 8,500 instead of 7,500. What's gonna happen in year 2022? How much is the shortfall from prior years? Only 500 remains.
Yes.
So how much are they gonna?
They're gonna get 7,500.
7,500. Because the makeup provision kicked in. And there was $500 left. So that's 7,000 plus 500. So this is how the makeup provision kicks in, is that in years in which there's a lot of income being generated, they can dig into the shortfall of prior years. And that's why some people do this as like a semi-retirement fund. For charitable community trust purposes, how is income defined? Income is generally defined as fiduciary accounting income. Right? What's my authority? 664-3A1, one little I, B3. I'll repeat. 664-31I, B3.
Can you
Question
repeat that
F1.
question? What question is that?
E. How is income defined? As fiduciary accounting income. Question F1. A contributed Blackacre real estate income producing property with a basis of 100,000, fair market value of 500,000 to a CRUD. If the CRUD sells Blackacre for 600,000, can any or all the gain be allocated to income? Okay, so the gain here, right, is 500,000. And the regulations here say in that case, the 400,000 pre-contribution gain, the 400,000 pre-contribution gain must be allocated to principal. And the additional $100,000 gain can be allocated to income or principal depending on the trust instrument. I'll repeat. The $400,000 pre-contribution gain has to be allocated to principal. The $100,000 of additional gain can be allocated according to the trust instrument. What's my authority for this? Same regulatory site I just gave you. 664-3B1, one little I, B3. Just pointing out to you that if Blackacre were subject, okay, to a $200,000 mortgage, if the trust pays off the mortgage, is that a problem? Okay, and that would be because here A would be receiving a benefit, and it would be taxable to A as a grantor trust under Code Section 677, right? And a grantor trust cannot be a charitable trust, okay? You cannot have a grantor trust, which is a charitable remainder trust. Remember how we spoke about charitable lead trust? They can be grantor and non-grantor. That's a lead trust. A remainder trust cannot be a grantor trust. May additions to corpus be made to a charitable remainder uni trust? And the answer is yes, right? You can make additions,
But not to the trust.
but not to the charitable remainder annuity trust. What is a flip charitable remainder unit trust? That's when it flips from being the lesser income or a fixed percentage, and it flips to being a standard charitable remainder trust. And you just can't have a flip charitable remainder trust arbitrarily. The governing instrument says that must require that the flip only occur on a specific date for the occurrence of a single event, which is not discretionary. So when you set up a flip, it's got to be a fixed time. Again, there can be no discretion here. And the flip commences in the year following the event, and once the flip occurs, the makeup provision cannot apply. And all deficient, like once the flip happens, there's no more makeup. The deficiencies are all erased. How are these charitable trusts taxed? As we said before, they're not taxed, right? Everyone agree? They're not subject to tax, the charitable remainder trust, unless they have unrelated business income. And if they do, they're subject to 100% excise tax. May a charitable remainder annuity trust or unit trust distribute property in kind? And the answer is yes, right? Regulation 664-1D5. 664-1D5. But if they do, it will recognize gains which will create taxable income to the beneficiary. What's the basis? The distributee's basis in the property received? Fair market value, right? Under Keenan, right? The recipient takes a basis equal to fair market value. Are charitable remainder annuity trust or unit trust subject to excise taxes? And in the chapter, it does point out that these kind of trusts are subject to excise taxes similar to private foundations. Suppose taxpayer sets up a charitable remainder unit trust, transferring $100,000 to the trust. 2 years later, he sells Blackacre worth $50,000 to the trust for $5,000. So it's being sold at a deep discount. That should be good. But are there problems? Yes, because you can't, that's a self-dealing transaction. You can't do that. That's prohibited under the private foundation rules. There's a code section that prohibits self-dealing. What's my site? Code section 4941D1A. I'll repeat, 4941D1A. What is the tier system? The tier system is the 4 tiers that are discussed in the chapter, right? If a charitable remainder annuity trust has $3,000 of ordinary income for the year and accumulated has $3,000 of ordinary income for the year and accumulated ordinary income of $15,000 is required to pay $5,000 to Pete. Charitable remainder annuity trust has short-term capital gains of $4,000 for the year. What is the character of the income that Pete is distributed? 5,000 ordinary, right? Suppose in the question before there was 1,000 of accumulated ordinary income and 2,000 of short-term net capital gains and 2,000 of long-term capital gains.
4,000
4,000 ordinary, right?
And 1,000.
And 1,000 is short-term capital gains. Okay, if you have the following chart, and the charitable remainder annuity trust is required to distribute $20,000 per year to beneficiary A, describe how A will be taxed on the amounts distributed to him each year.
We have 10.
20,000?
I distribute 10,000, good? 10,000,
Yeah,
right?
okay.
All right, so you guys come up with each year the character that will be distributed, okay? You know the total distribution equals 10,000, so it's a matter of character, right? In year 2020, guys, what's the character?
8%, 8,000 ordinary and 2,000 short-term capital gain.
Okay, 8,000 ordinary income, right? And 2,000 short-term capital gain. And just so you know, we might as well keep a chart what the excess is. That means of the excess, we have 4,000 short-term capital gain that we didn't use, right? Everyone agree? And 3,000 of long-term capital gain, right? Let's just keep a running tally, right? That we're going to carry for the next year. Agreed? 2021, we know the outcome, but what's the character?
6,000 ordinary income.
6,000 ordinary.
And 4,000 short-term capital gain.
Okay. 4,000 short-term capital gain. And what is the excess here?
Leftovers, 3,000 short-term capital gain.
Okay, 3,000 short-term, so the total here is 7,000 that we're going to carry over, right? And what are we going to carry over?
Loss.
A loss, so we're going to carry over $1,000 loss, right? Everybody agree? And the long-term capital gain. In 2022, what are we going to do?
7,000 ordinary income.
7,000 ordinary income, right?
We have some carryover
after we experienced a loss this year, right? A short term of 5, which would be netted against the 7. So how much is left?
2.
2. Bless you. Joe. All right. And finally, what's left of the long-term capital gain? They had 3,000 capital gain, but there was $1,000 of the loss, so we could use 1,000, right, of the long-term capital gain. And that would leave 1,000 in the column for the next year, right? There's 3,000, right? But that gets netted against the accumulated loss, so there's 2,000. So that means that we would use 1,000 of the 2,000, the other 1,000 would be carried over. Everyone see that? Right. I don't think we have to rush this, and you guys will kill me if we go too late. So let me just tell you what I propose we do. For next class, we're going to finish going through this, and if you could, it would be good, because it will be a good transition to just making sure everyone's read the material and caught up. So, and if you don't have the chapter, shoot me an email. Everyone should, in your email, have this chapter. And then you should have the chapter on charitable, on IRD code section 691, which comes up all the time with respect to subchapter J. You do not have to bring your textbook next class. Do bring both chapter 7 and chapter 8 of the material I gave you. Again, in the next 3 weeks, I will be around, so if questions come up, let me know. Let me wish everyone a happy Thanksgiving, hard to say. And I will see everyone here.